All right, let's talk about Hexatronic Group. This company is listed in Stockholm, although a majority of their business is being done in America. As you can see, they've had a tremendous start since being listed, and company performance is quite strong. In this video, let's take a look at where they fit in the value chain, some of the lead optimization that's going on the landing page, and then we will take a look at institutional ownership and some highlights from the quarterly earnings report. I also have a good anecdote to share on the state of business in America and how come this company is in a bullish cycle right now. Because remember, the company is communicating that they want to see greater than 20% year-over-year growth on a 4-year cyclical average. So they're overperforming right now, indicating that they're in a bullish part of the business cycle. So this is cyclical, just like for semiconductors and some other business verticals. But we will take a closer look at this later on in the video. Let's first take a look at the landing page. I think it's well optimized if you're a business taking a look at Hexatronic, trying to understand how they can help, how they fit, what value they provide. We see here that they're clearly using some good SEO terms as well, talking about being an enabler in building digital infrastructure for businesses, individuals. This is something that's very useful. They talk about where they fit in the value chain, how they use components, and how they use some supplier parts as well to manufacture the needed parts, and then they also help with implementation and field support and basically being full service in the value chain here, talking about how this results in total cost of ownership benefits. And this is something that's being talked about in complex sales cycles. So this is clearly optimized towards businesses when we look at this landing page for Hexatronic. These are business terms. This is the financial language that is used in larger deals when talking to the CFO and trying to get sign off. So clearly some sort of optimization going on here on the Hexatronic landing page. Alright, so they talk about businesses and we see that they optimize towards it. Now in America, I know that for certain cases, the connectivity is indeed an issue. Let's say you have a data center and you have a replication site that you send your data to. Well, the public digital infrastructure in America is not the greatest, and companies need to boost this infrastructure for replication to actually function, for the data to be able to be sent through, since this is something that is lacking currently. So there's clearly great demand for this type of infrastructure. So this is something that I remember from business cases about American data centers, and companies need to front this cost. A similar setup in, for example, Sweden would not need additional infrastructure boost in the same way that American companies do. So in that way, Hexatronic Group is in a good spot in the market to take advantage of this business cycle and this need for improvement. However, these things are cyclical, so these things can go down. And we see that the company have a price to earnings ratio of 15. So this indicates that the market continues to believe that they will grow. This is priced into current share price. And the company will need to deliver on this indeed. Taking a look at the balance sheet, however, we see that the company is communicating that they want to do some dividend. And this could potentially be a bearish sign if they're not able to find profitable use for capital internally. Well, yes, then they pay it out to shareholders, give back to the owners. However, it's priced into the stock price that they indeed should do some more growth. Why do you say this, Andreas? Well, if we look at margins, the EBITDA margin here, we see it's 17.4% for this, and the company communicates that they want to have somewhere between, I think it was 14, 15 and 17% on the long run, so they're a bit on the upper edge right now. But clearly they're not going to get software company multiples, so there's some growth priced into current stock price. We see in terms of net sales, fantastic quarter, 52% year-on-year growth comparing the 2 quarters. And we see in terms of earnings as well, fantastic. We see here the EBITDA margin that I talked about earlier as well. All right, it was 17.2% for the first quarter here of 2023, so still on the upper edge. That's good numbers for the first quarter. And we can also scroll down a bit and we will find a list of institutional holders, but before we go into that, we can see a graph over net sales. So company performance is strong, a clear uptrend here, not only the COVID sort of era, but also pre-COVID era here with numbers from 2019. And take this EBITDA margin rolling with a grain of salt. They probably selected the most good looking statement here to add to this graph. All right, let's take a look here. Here we have the slide I was looking for. So we see that AMF pension and funds, 8.3% of the votes, quite a big amount of shares. However, we see that other shareholders are coming in at 53% here. So not full institutional buy-in. We see some Jonas Nordlund here, privately and corporately as well. Quite a big stake. But funds don't have a huge stake. We see some buy-in here. We see the Bank of Norway as well. Interesting. Folksam, another institution. But there's clearly more room for bullish pressure from continued institutional buy-in into the company. It's not fully saturated yet, as we see in some other cases where institutions just hold a massive amount, some like American Waterworks company, for example. Look at institutional ownership on that. You can just Google it and see really high. And I think that this company will go more towards that as they continue to generate good track record of numbers. So quite good for Hexatronic shareholders, quite bullish. We can see the income statement here as well. Let's go over it together. Let's take a look at operating expenses and see if they control expenses in a good way. We can see quite an increase from the first quarter to the second quarter. However, remember, margins were good and revenue grew by 50-something%, and this is clearly less than that. So that's why we have some of the good numbers in the margins. Personnel cost, quite the increase. They've had to hire a lot. I think there are 2,000 people, give or take a few hundred right now, employed in this company. And depreciation of tangible assets. All right, some depreciation as well for accounting purposes. And let's take a look at operating results as well. Net result for the period, great increases here. Do they have any intangibles? No, not really. Earnings grew greatly, as we knew from the highlight statement. However, not a lot of accounting tricks to write down the value and get less tax. We don't see any write down of goodwill or anything else in this statement. Here we see amortization of intangible assets. Yes, quite small here. This is something that I noticed on a few quarterly earnings reports where they write off a large part of their intangible assets, and then the sort of net income that they're going to get taxed on gets super low, and this of course reflects in the numbers, although not in cash flow. However, this is not the case here. So if they all of a sudden do some large write-off on patents or some goodwill from some acquisition, then this would reflect here in the numbers, and it could potentially shock some investors and scare off some smaller investors that think, oh, this is a bad quarter, this is something's terrible is happening with the company, and then they just sell instead of holding through the period, and then next quarter maybe they don't write off goodwill anymore and they get fantastic numbers, and then the market is surprised and goes up 30% or something like this. So remember, I just talk about this because there's potential for a short-term bearish shock if they do some large write-off here, and we see this affecting results of the company. Don't just blindly sell on panic. Look in the operations statement here, consolidated income statement, and take a look at what's actually been going on. If operating expenses ballooned, or if it's revenue, net sales that's dropping, then it's a bad sign. But amortization of intangible assets is something that can get to small retailers like you and me and get us to paper hand, as they sell our shares. All right, let's take a quick look at the balance sheet as well, and then we will wrap up this video. So we see quite a few intangible assets on the balance sheet. This is in million of Swedish kroner. So if you want to convert this into US dollars, just roughly divide by 10 as well, and we can see that intangible assets has increased by quite a lot. That's another justification on why I did this large tangent and explanation on the income statement side of things, because sooner or later we will see write-downs on this value, and then you will know what's going on and you will not panic. Information is the sort of cure to this type of panic. You're educated and people can't take advantage of you, and you won't make as stupid decisions in some cases. All right, so total current assets, this is 3 billion. Yeah, exactly, $3 billion. All right. Quite the increase in equity as well. Current liabilities, some deferred tax. All right, they have leases as well, like this. It's a good way to utilize the balance sheet, not own everything. It's a more effective capital structure in some cases. Just buying a lot of assets and having ownership of that can be quite expensive in a lot of cases, but leasing is a way to control expenses and be less impacted by business cycles depending on how long the lease is. Let's take a look at some of the, let's see, where do we have here current liabilities or short-term liabilities in some cases. This is more short-term debt. This is important to look at in some cases and just compare to current assets, and we can see that total current assets is quite a lot larger than total current liabilities. In the property sector, this is an issue right now, with current liabilities being larger than cash on hand. Inventories here is the worst part of total current assets. You can't pay your bank or investors or bondholder or whatever it might be back with pipe, with fiber cables. I'm not gonna accept that. They need cash, so you need to actually move this inventory. Doesn't seem to be a problem at all for this company right now. But if the cycle shifts and all of a sudden they're stuck with a lot of inventory, of course that would be bad. However, even accounting for inventories, 1.7, so 7, that's 2, still larger than current liabilities. Subtracting for inventories, this number is still larger. And of course, liquid assets here is the best part of total current assets. This in this balance sheet will basically be your cash and cash equivalents. What's cash equivalents? That's extremely short-term government bonds, for example. That's just as good as cash in this case. So we can see that the balance sheet is quite stable for this company as well. So in terms of my judgment for this company, I'm quite bullish on Hexatronic. I think they have a good position in the market. Their total market cap here is 13.5 billion, so it's not a small cap by any means. However, in terms of US size, I guess it's small to mid cap. This would be about 1.3 billion in US dollars. So there's plenty of room to grow. It's easier to grow when you're small than when you're a mega cap, say. So those are things that are speaking in advantage for this company. I really hope that shareholders make a ton of money, and for you guys, whatever investments you decide to make, I hope you make a ton of money. That's been it. Wrapping up this video. Take care. Bye bye.